Hi students, this is the first video on chapter 12 on investments, and a lot has changed in investments accounting in the last 5 or 6 years. All of those changes have now been implemented, and so I'm not going to teach you the old way of doing things. We're just going to focus on the requirements now, which will also be the requirements going forward. So first thing you will notice is right here, an investing company always has the option to account for these investments at fair value, with changes in fair value reported in the income statement. Now that's what's commonly referred to as mark to market. Now the rest of this we'll get to later. There are different ways of accounting for investments, different types of investments. We'll get to all of those in a minute. So we will move on down. Here's an example from Coca-Cola's financial statements. And you see in note 3 on investments right here, investments in debt securities are not classified as held to maturity, are carried at fair value and classified as either trading or available for sale. Realized and unrealizable gains and losses on trading securities and realized gains and losses on available for sale securities are included in net income. Unrealized gains and losses, net of deferred taxes, are on available for sale securities are included in our consolidated balance sheet as a component of AOCI. AOCI stands for Accumulated Other Comprehensive Income. Now, we've talked about that account before. The thing I want you to see here is there are, for debt securities, mainly bonds, but commercial paper, there are other forms of debt securities, but it's mainly bonds. There are 3 classifications for those. We'll get to those 3 down here in a minute, but held to maturity, which you see mentioned right here, is one type. And then we have trading securities, and finally available for sale securities. Now you see available for sale securities here, they're not accounting for at fair value through net income. Only realized gains and losses for available for sale are included in net income. And held to maturity securities, that's kind of a different ball game altogether there. So we'll look at all of those, but I want you to understand those are the 3 types of debt securities: held to maturity, available for sale, and trading securities. So we will move on down to the page 646 and give you an example of debt investments here. And not a whole lot wanted to talk about on this page. They do get into companies that invest in debt to companies invest in debt too, like a CD, a bond, or other debt security. Now, in order to be a debt security, the real telling characteristic is that it has a specified date when it matures, has a maturity date. At that date, the principal, also called the face amount, or the maturity value, has to be paid out to the investor. Now, along the way, debt instruments also pay interest. So investors are acquiring 2 streams of cash flows. One is periodic interest payments, and usually with bonds, interest is paid twice a year. And then the other cash flow is the principal payment or face amount payment at the maturity date of the bonds. So now we've talked about this earlier. You'll get into it more in intermediate accounting 2 when you'll cover bonds in detail. But with bonds, they usually sell at either a premium or a discount. Now, if the market interest rate is higher than the stated interest rate on the bonds, meaning you could go out and invest in other securities at a higher rate than the bonds you're paying, then the bonds usually sell at a discount. If the bond interest rate, the stated rate, is higher than the market interest rate, then they usually sell at a premium. So we see down here an example where the bonds are paying 12% and the market interest rate is 14%, so we would expect to see these bonds sell at a discount. They have $700,000 worth of bonds and they sold for $666,633. The $700,000 is the face amount, and at maturity, that's what the holders of the bond will get. So they'll get their periodic interest payments, and then on maturity, they'll get the difference between this amount that they're paying and this amount that's the face amount that they'll get paid. That difference is really just additional interest. It gets amortized on an effective interest method, and we've talked about that before. But anyway, you see here an example of bonds selling at a discount. Now they move on down and explain some of the characteristics there. But here is what we're interested in, really, is you can classify debt investments is one of three types. I've mentioned these: held to maturity, trading, or available for sale. Now, first we're going to discuss held to maturity securities, but right here you see the accounting. It doesn't matter which one of these three ways you account for them. The initial purchase, the transaction is recorded exactly the same way. So in this case, we debit investment in bonds because we bought bonds with the face amount of $700,000. So we debit investment in bonds for that face amount. We credit cash for the amount of cash paid, and the difference goes into discount on bond investment. Now that's all going to get amortized away and become interest revenue, so that the net book value initially at acquisition is the amount of cash paid. As we amortize this away and it goes to zero, the face amount of the bonds will become the net book value as well. So they talk about here the discount on bonds investment is a contra asset that's contra to the investment in bonds account. It reduces it. Now, if the bond's sold at a premium, that premium is what's called an adjunct account. It would have a debit balance. And so if the bond's sold for $710,000, then we'd have a $10,000 premium on bonds payable. What that represents is a reduction in the amount of interest that we're going to receive over the life of the bonds. So as we receive interest, part of it is actually interest, and part of it is giving us our money back in the form of that premium. Because at maturity date, all we're going to get paid is the face amount of the bonds, the $700,000. They talk about the effective interest method a little bit right here. Again, we have talked about that before, and anyway, I'm not going to cover it again in this chapter, but let's see. Let's move on down. And here is the amortization of the bonds. I'm sorry about that little pop-up that keeps popping up. But here is the amortization of the bonds. So the way we, using the effective interest method, the way we calculate interest revenue is the effective interest rate times the face value of the bonds. So paying interest twice annually at 14%, so that's 7% each interest payment. Multiply 7% times the net book value of the bonds. That's how much interest revenue we record. Now, to get how much interest is actually paid to us, we multiply the face rate times the face amount. The face rate was 12%, interest paid twice a year, so that's where we get the 6%. And $700,000 is the face amount, so 6% of 700,000 is 42,000. So the difference between the interest revenue earned and the cash interest that was paid to us is amortization of the discount. Okay, we have a homework problem, so we will jump down to that. And right here is the homework problems. And here we have brief exercise 12.1. Lance Brothers Enterprises acquired $720,000 of 3% bonds dated July 1st on July 1st, 2021 as a long-term investment. Management has the positive intent and ability to hold the bonds until maturity. Now that's the requirements to account for the bonds as using the and my mind just went blank, held to maturity method. And so we're going to, our plan is to hold them to maturity. And we have both the positive intent and the ability to hold them until maturity. In other words, we don't expect to need the money. We're going to collect the interest and then collect the principal at the maturity of the bonds. So the market interest rate, or the yield, was 4%. So the bonds are paying 3%. The market rate was 4%. We would expect to buy them at a discount for bonds of similar risk and maturity. Lance Brothers paid $600,000 for the investment in bonds. So they paid $600,000 for bonds at the face value of $720,000. So they bought them at a $120,000 discount. Paid $600,000 for the bonds, and will receive interest semi-annually on June 30th and December 31st. Prepare the journal entries to record Lance Brothers' investment in the bonds on July 1st, 2021, and to record interest on December 31st, 2021 at the effective or market rate. Okay, now first, the acquisition of them. We're going to debit investment in bonds at face amount, $720,000. We paid $600,000 cash, so we're going to credit cash for $600,000. Then we're going to credit discount on investment in bonds, or discount on bonds receivables, something like that, for the other $120,000. And so there we see that our investment in bonds at the face amount of $720,000, and then our credit cash for $600,000, and they messed this up. They indented it here but didn't indent it here. This should be a credit. So credit to discount on bond investment. So let me just fix that right here. There we go. Credit to discount on bond investment for $120,000. Now, when we receive that interest payment, again, we get paid cash based on the face amount and the face rate. Face rate was 3%. We're getting half a year's worth of interest. So that means, oh, and our time is running out real quickly. That gives us the $10,800. Our interest revenue is at the effective rate times the net book value, 12,000.